Good afternoon. This is Blake Young with the TheoTrade Nightly Video for January 5th, 2023, and today we're talking about reading the jobs report crystal ball. What we're going to do is we're going to use the ADP information today and the expected non-farm payroll for tomorrow morning, Friday morning, which will give us an insight, maybe a glimpse into the future about what we can expect with Fed rate hikes and potentially what we might expect in conjunction with the next move in markets. To start out, let's look at how we behave today. A couple things to highlight. This white line, or these white lines, are still our long-term 1-year 2023 look-forward levels of overbought and oversold. So the weekly candle closes, if we close between 39.21 and 41.54, which is a wide range, that is an area that we'd be looking for bearishness, or at least a sentiment that we are overbought and possibly going to push lower. In addition to that, we see that we keep testing the top overbought for the month of January. We tested it here on the first day, we tested it again, and we're closing down, but reality is we're now stuck going all the way back. We have not traded out of the same roughly 1.5% up or down range since December 16th. And so the markets are stuck and indecisive of which way they should lean. But today's data seem to start pricing in a little bit more downside. In fact, if we look intraday, I've already got my intraday values here, and we look at the behavior in the price action, you can see that it's still like the overall overbought, oversold areas for the day. Overnight, we traded back and forth. We attempted a breakout through here, but overall, we see we made a higher high, lower low, continued that down, and found the 200% level, or the bottom of this projection, for the intraday, almost as the perfect barrier. And we traded flat most of the day. When we did break out of it, all we did was went and retested the 50% fair price, and so it definitely likes the projections and the balance for what we're seeing. Now, what was the data today that would help us figure out or predict what we might expect going forward? ADP non-farm payroll data, which it used to be, ADP was arguably a cleaner indication of what the jobs report was going to do. ADP used to report just what paychecks they were cutting, what payroll services they were offering, and used to show, therefore, what private sector jobs were being added, taken away, built. And so it used to be a pretty good indication of the private sector, while the non-farm payroll for the government was all of it. It would include everything, but it was done as a survey and still is done as a survey. Today's ADP, and over the last few years, today's ADP and over the last few years is now a survey. So it's a very similar component and just a predictive tool to the predictive tool. It's predicting what non-farm payroll should do in the next day, meaning tomorrow. And what we're going to do is use that information to determine what we can expect going into next month. So to start out with, let's jot down these numbers, and we're going to show you the difference that we're going to be looking at in conjunction with ADP, pointing to a significant beat in non-farm payroll on Friday. Let's look at the previous couple of months, just to get an idea. And we're going to compare ADP, which is the payroll service company, versus the non-farm payroll, which is the government report. Now, if we're going to look at this, we're going to look at November, we're going to look at December, and then we're going to guess on January because we already have January's ADP, but not the non-farm payroll, which comes out tomorrow. Non-farm payroll for November ADP report was expected to come in at 178,000 new jobs. What came out of that ADP report, however, was 239,000 new jobs, a significant increase over the analyst expectations. 2 days later, generally ADP's on a Wednesday and non-farm payrolls on a Friday unless there's a holiday. Obviously this year Monday's holiday pushed ADP back a day, so that's why we had it today, while non-farm payroll will still be tomorrow. So we'll look at that in here in a minute. But non-farm payroll was pricing in 197,000 jobs in November, and it came in at 261,000 jobs. Now, if we were to look at what happened with the expectations in the chart, we want to go back and say, okay, what happened on November 4th? If we look back at November 4th, that was when we had ADP report, or sorry, non-farm payroll report. And we had a little bit of a bounce here, but we had a significant sell-off in ADP pricing that in. So we had a sell-off, some continuation. Reality is we settled in exactly at the response of an increased job report. Normally, in a healthy economy, more jobs means healthier economy, means more spending, means higher move in equities. However, in our current market, stronger jobs, hotter job market has investors saying, oh, we're going to have more Fed rate hikes. And if we're going to have more Fed rate hikes, that means more higher costs to borrow. And if we have higher costs to borrow, could we be setting up and looking forward to see maybe a move that is going to price in a greater rate hike past the terminal rate of 5%, 5.25%? Is that going to cause a slowdown in the markets? Now, if we look at December, hang on, let me write these down quickly as well. If we look at December, we had a mixed story. So sometimes ADP is not as indicative of what's going to come out of the non-farm payroll out of the Fed. Usually it is, but sometimes it's not. But I'm going to show you why we're expecting this to agree this time. Last November, very end of November, reporting the first week of December, the ADP reported on Wednesday, and it was expected to come in at 196,000 jobs, and it missed. Okay, it missed and went lower, and came in at 127,000. So that was a major miss, and so we'd have said, oh, you know what? We're probably going to miss non-farm payroll as well. We didn't. Non-farm payroll, the very end of that week, the next report on Friday, beat expectations. We had 200,000 expectations, 200,000 jobs expected, and that increased to 263,000 jobs. So another major win in ADP. Now, why did that, or in non-farm payroll over ADP? Why did that happen? I believe it's due to JOLTS, Job Openings Labor Turnover Survey, and I'll show you what's happened this last week. Hit there. As we're looking at these numbers, this report, we'd go back to December 2nd, and higher jobs. So when ADP reported, they say, oh, major miss. See, we're getting inflation under control. We're seeing jobs decline. And the market said, good, no higher interest rates. And it pushed the market higher. But when we saw that non-farm payroll came in higher than expected, it pushed that number down. That's 263 is what I'm circling. You can't see that. It's an arrow. This is an arrow. So 263, much better than expected. And we pushed prices down. We tested this low, and then we continued lower after that. So why is non-farm payroll higher? Well, I believe it's because we had more job openings, and ADP is a limited survey, and non-farm payroll is theoretically a much broader survey of the whole economy. What happened this week? If we look at this week, and we look at ADP and job opening labor turnover, job opening labor turnover, or JOLTS, reported that we had 10,460,000 job openings. And we upgraded the previous month to 10,510,000. So massive number of job openings when we have maybe 5 million people looking for jobs. Actually, it's a little less than that. We have about 2.5 jobs for every person that wants a job, 2.5 job postings for every one person that wants a job and wants to be hired. So that number outperformed in December, and it was seen in non-farm payroll. If there's a bunch of job openings and people looking, if they're willing to look, they can find a job. So this week, JOLTS came in at 10.46 instead of the 10.04. So we have another 400 and let's call it 454,000 job openings waiting, more than what we thought, and still have 10 million job openings. ADP came in, or was expected at 152,000 jobs, and it came in at 235,000 jobs. Massive beat. Almost 80,000 more jobs than we thought, almost 400,000 more job openings than we thought, 10 million job openings overall. So we're expecting to see non-farm payroll outperform. And if outperforming, will we see that as justification that the Fed is going to continue to raise rates? In fact, are we going to see it priced in today? Are we going to see more of it priced in tomorrow? And we could talk about the weekly unemployment reports as well, because I think that's a pretty good indication. And right now, analysts are forecasting 200,000. If we see a similar move, it could be the highest number we've seen in months. and could see 280,000 new jobs. If we're to look back historically, and if this is roughly the same move, if we see 280 instead of just the 200,000 expected, 280,000 would bring us to the point where we have, let's say, the same level that we had in September. So we're going to eliminate that last quarter that we saw a slowdown. We could be pushing up to September levels, and reality right in the mix of what we saw for the entire year. Lots more jobs seems to say that we are resilient, that the rate hike has not slowed hiring, has not slowed demand, has not stopped inflation, and that should be maybe an early indication for what we're looking at. Where can we look for additional information? I'm going to go to the ZQ. The ZQ is the indicator that says this is what we're pricing in for the Fed funds future. Looking at the Fed funds future, we're going to use not the January report, because January we're not going to raise rates. We don't have a meeting until February. So we're going to put in the February contract and look at the data. February contract is the G23. So we leave ZQ G23. I'm going to hit enter, and this is going to show you the response to ADP. Now what we do, if you want to get a sentiment of what the market is pricing in, and I like this tool or this indicator, let's call it an instrument, this trading instrument, this future, as a put your money where your mouth is indicator. This is not just an indicator that says, well, we may or may not get a rate hike. This is saying that people are betting millions and billions of dollars on these moves. So what we saw from yesterday to the lowest point today is we saw a drop of about 95.36 to 95.30. That may not seem like very much, 0.06. But what that is a 24% increase in probability of a move to 50 basis points instead of 25. So just off of ADP, we already started pricing this in. If non-farm payroll comes in tomorrow higher, we will likely see it drop down here. The way you can calculate what is expected, and this is an oversimplification, you can just go look at the CME's Fed Watch tool, but I like using this. So if we take 100 and we subtract off this number, this is today's close, 95.33. This is giving us the discounted rate, it's Fed discount rate, or the Fed funds futures, and equates to a percentage. We take this number and we say that is 4.67. So we're pricing in 4.67 in the bond, or the Fed funds futures. 4.67 versus the current rate gives us an idea of what percentage and how much the next rate hike could or should be. Our current rate for the US is between 4.25 and 4.5. So if we assume halfway between, then we'd be looking at 4.375. Oops, 75. And that would give us a rough number of an increase of 0.30, roughly. I know I've taken off that 0.05, but 30, that is a full 25 basis points. And an additional 0.05 of 25 basis points. So today's price, I would say, is 100% probability of a 25 basis point hike. And today's rate would say there's a 5 out of 25% probability, and we can call that 20% chance of a 50 basis point hike. Now, you might say, well, that adds up to be more than 100%. Correct. So what we're saying is there's no chance they're not going to raise rates. And so if we're saying there's a 20% chance here, you could say, therefore, there's an 80% chance that we're really going to raise these and a 20% chance that we're going to raise at 50 basis points. That is still an increase off of ADP. Non-farm payroll, if we hit the numbers, we should see it drop down here to probably 95.26. And if we go to 95.26, we're going to be pricing in, let's do the math really quick. If we get down here, and this is just kind of a support level, if we go to 95.26, I'm going to use 95.25 to make my number a little bit easier to calculate. That's going to be 4.75 versus our current 4.375, and that's going to tell us that we have about a 50% chance that we're going to raise 50 basis points. So if that Fed funds rate drops down here, if non-farm payroll is higher than expected, is 80 or higher, then we will likely see more pricing in of a bigger rate hike in February. And we could do the same thing for March and April and all the way out to June. And if we're looking at March, you can see it's 95.25, that number we just calculated. So that's pricing in 50% chance of 50 basis points by March. That's already pricing that in. And if we see that drop in here, we could start pricing in another 25 basis points. If we're looking at that, we could go all the way out to, say, June, where we've seen the next move. And we're not really trying to price in everything, but June's next move, or the move by June, the Fed funds rate by June, is an M23. We can do the same math. Are we at the 5% level? 100 minus 94.98. That is 5.02%. So we are still pricing in a 5% rate by June, and it could go even higher if we can get back below 94.80. So everything seems to be pointing to bearishness in the Fed funds future, which means higher interest rates. Everything seems to be pointing to a stronger employment data number, and therefore, if we're going to see higher rates, will the market tolerate the higher rates? Will real estate tolerate the higher rates? Are we expecting to see all of those fall? Well, we can use today's price action to estimate tomorrow's range and where we might go to, regardless of which way non-farm payroll comes out. So I'm going to go into styles and monkey bars. We're going to go into a single day. This is today's close day. And we're going to use this low and high and the fair price. You can see it's pricing in bullishness. Let's do this really quick. Anchoring the low to the high, it's very fascinating to see that we had a very clear double, what they call a double auction. And our fair price up here is matching up to the 20 percentile. I find that this is pretty indicative when we line up fair price to either the mid price or the 20% levels. That's a pretty good indication that we are going to respect these levels again. So we take the mid price, we go to that 20% level. We're going to take 2 times this and re-anchor from the 50%, 38.54, to the 200%, 39.23. And after we re-anchor that, we just go back into the regular charts and go into the intraday. And if we're looking at the intraday, where is it overbought, oversold? It appears right now that the overbought area for tomorrow is between 38.40 and 38.54. So if price can get back up into this area before non-farm payroll, before the market opens, and if non-farm payroll comes as bullish, positive, as they call it, a hot employment market, then I'm going to expect us to break down below 38.40 and probably at least test this 3800 to 3790. There's going to be maybe 50-point movement there. 50 point is a 1.5%. If it's much stronger, if it's even the 80,000 or more, then we could turn this into a bigger sell-off and we could duplicate this entire range. Which means if we duplicate the entire range, we're probably going to break through the 3800 to 3900, which is overbought. If we break through 3770, we're trading through fair price, and my next target is 3720. If the non-farm payroll beats, that's where we're headed. If we get really surprised and it's a complete miss, then we go the opposite direction. If non-farm payroll slides, then we see a break above 38.67 and probably a retest of 39.20, which is the overbought area for the month, overbought area for the year, overbought area for the day, and I would not expect us to stay above 39.20. But that's my outlook, and everything seems to be pointing to solid jobs, so we will see, and then we'll see what happens with those Fed funds rates as well. Have a great night, have a great morning, and we'll talk to you tomorrow.